All right, so good morning one more time, and you are welcome to financial management class. Now, this is our first lecture, so like I said, I will introduce to you the syllabus, then we take it up from there. Now, I hope you can see my screen.
Yes, sir.
All right, so now this new syllabus it was spanned from 2024 to 2029. So and the content of it are what we are going to discuss in a few minutes. Then we move on to the main session into the class. Now, your question or your exam is a 100-marker exam. So, and we all know that the pass mark is 50%. So this is the breakdown of the examiner. And this is not only for ICA, it's the same thing for Nigeria, it's the same thing for ACCA and stuff. Now, so what you see in here is that the examiner has weighed the topics, and you can see that it says that the environment of financial management is 5 marks. Now, even though he says the environment of a financial management, when we pick the environment of financial management, the environment for financial management, the kind of things that we are going to be discussing in there are plenty. There are plenty of things. We are going to start explaining what financial management is. I mean, we're going to introduce to you what financial management is. So the nature, all right, and the objective of financial management. It's part, and that is where everything starts. So here we are talking about the nature and the objective. What is financial management? What is it at all? And that is what we will be looking at, the nature and the objective. That is not the only thing. Even though he's saying the environment of a financial management or financial management, what you actually see also here is that you'll be talking about the financial objectives. All right, financial objectives and strategy formulation. So, and this part is also in your corporate case study, like the case study that they do in level 3. So this part is also very important. The strategy formulation, when it comes to case study, is very important. So everything you are learning here, this is not something you learn and you throw away, but it's something that you will use again. Then, after knowing the financial objectives and strategy formulation, the next thing that you are going to go through to also try and understand is the financial and other objectives of not-for-profit making organizations. So you have financial objectives and strategy formulation for like a private entity or a listed entity. But when you come to the not-for-profit making organization like public sector, I mean, service providers, they also have their financial objectives. So we will be looking at their objectives, financial and other objectives of non-profit making organization. All right, so that is that. So you'll be having that. Now, aside this, it still doesn't end there. Aside this, what you will be learning is corporate governance, which is a major issue these days. Corporate governance. So you see, these two, this one and 2, they are also in strategic case study. So you have to be very careful. You don't throw them away. You have to still keep them. Then you also have the regulatory environment, because as you can see, it said the environment for financial management. So you have to talk about those regulatory bodies that regulate financial management. All right. And these are the 5 main things, all right, that we are going to study. The 5 main things that we are going to study. Now, what you should understand is that any of these 5 can come in your exam for 5 marks. Any of them. And that is the way. Any of them can come for 5 marks. So when we are done today, you need to have a grip of all these 5, what they are. They are short, what they are. And so that you can use that for your, assurance of having your 5 mark in the exam. One of them is always tested. All right. So take note of that. Take note of that. Now, then when we are done, we come to 2. Even though this one has been arranged that it is sources of finance and financing decision, from my side, the second thing we will be discussing wouldn't be sources of finance. The second thing we will be discussing will be how to do investment appraiser. Investment appraiser. All right. And this one, we will talk about the DCFs, the non-DCFs, and the DCFs, non-discounting cash flows and discounting cash flows. All right, then we will go further a little to talk about specific decisions like lease or buy, replacement. All right, and some of these things you will be doing it in man accounting too, like it's the same thing. In man accounting, they call it long-term decision making. All right, so you go through that. Then when we are done, the next thing that we will be focusing on will be this one, the E. We will be doing working capital. Working capital management. Now, in the working capital management, those of you who know accounting a little and you did ratio computation, you know that the working capital is your current asset and your current liability. So here in the current asset, we'll be looking at how to manage inventory so that if you are in any office, you understand how inventory is managed. You also learn how to manage receivables. You also learn how to manage cash. So you see, in some companies, they have receivable person, inventory person, the person also managing cash. They are individuals. Then on the liability side, the current liability side, we will be learning how to manage our trade payables. So if you go to some entities, they have a trade payable account officer. That's how they do it. All right, we are going to learn all these things. So this one is like you being in a finance department, apart from the accounting. Then the fourth thing we will consider in this class will be about now this one. So I call it business finance. All right, so we'll be looking at business finance. Business finance used to be 20 marks in the old syllabus. Now it is 15 because of the introduction of these 2 topics. So in the business finance, we'll be talking about the sources of finance. How do we get money? And how much will it cost us to get the money? And how we can fit them into our capital structure. So these are the things. Now, let me say that the new syllabus has made it so that the theory of financial management is becoming more than the calculation. Yes, because this public sector financial management, it is not calculation, it is theory. Development in technologies in finance is theory. And already inside these topics, there are theories already. So finance management is becoming more of a theoretical paper than a calculative paper. So you don't focus only on the calculation, but you try and understand. You read and you understand. If you read well, you can pass without doing the calculation. All right, so that is that. Now, the fifth thing that we will discuss after this one will be business valuation. Business valuation. All right, and then in the business valuation, we will be adding what we call acquisition and merger. It used to be 20 marks, but now that one too has been reduced to 15. And the investment appraiser, there was a topic called time value of money. That was 10 marks, and the investment appraiser was 15 marks. Now they've combined the two and given it 20 marks, which means that they took 5 marks out of it. And that is what they placed here. And taking business valuation, 5 out of business valuation 2. Yeah. And also 5, I think 5 out of this one too, the environment. So that is what has happened now. So we'll be learning acquisition and merger. It's a very simple topic. We'll be learning it. Then the last 2 which is more of public sector. So those of you who have done public sector finance management, the PFM, you have an idea of how this one is. So we'll be looking at the public sector financial management. All right, we'll be going into it again. You've done it in public sector, but there's another chance to get a 10 mark out of it. Now, the new development in technology. So we'll be learning something on technologies, the things we call the fintechs, the financial technologies. All right, we'll be going into that. So this is the syllabus, and as you can see, fintechs is 5 marks, PFM is 10 marks, business valuation 15 marks, working capital 15 marks, treasury management, yes, that is another thing. So we will be doing the treasury management. I think we will be looking at the treasury management, and that usually that's the last thing I teach as part of my course, treasury management, because the way it is very tricky. So we will be looking at treasury management. All right, where you will learn about foreign currency risk and interest risk. All right, interest risk management. So we will be learning that. All right, so basically this is how our outlook is going to be. That's how it's going to be. All right, so before I move on and start today's class, if there is any question, this is the time. Is there any question?
No, sir.
All right, so now let's start today's class by trying to deal with the first 5 marks. All right, so that you'll be assured. All right, so that is that. Let's go into it. So our focus today is on the environment for financial management. First of all, what is financial management? When we say financial management, what is that? What is the word financial and what is the word management? So those are the two things that has been combined together. So when we talk about financial management, and I'm not going to give out notes like that, but just to summarize things up, when you talk about financial management, the focus is on the financial. Of course, when you talk about financial, we are looking at money kind of resources, all right? So when you talk about financial management, we are actually talking about the management of finances of an entity so that the entity can achieve its financial objectives, all right? So here, our concern is about the efficient acquisition and the deployment of both the short-term and long-term resources of an entity. Now, the reason for the deployment is that they want to achieve the objective, the financial objective of an entity. So when we are talking about financial management, all we are saying is that you are managing finances, all right? So financial management is just simply the management of the finances of an entity. All right. So when you manage the finance of the entity, herein, what you are trying to do is that you are trying to achieve your financial objective. So that is the main thing, financial objectives. You want to, because private entity, as they may be, wants to achieve a financial objective. And so therefore, you are managing it. You manage their financial resources so that you can be able to achieve it. Now, in terms of management, we learn that management simply is about getting something and deploying the thing effectively. So when we talk about financial management, then it means that the word we are talking about efficient and effective deployment. So when we say deployment, you are releasing out, all right? Deployment of your resources, both long-term. So the resources, it is both long-term and short-term. So what you are doing is that you are releasing those resources to allow those resources. What resources are we talking about? The long-term and short-term resources that you have acquired, all right? You acquired them. So when you deploy them, what you are expecting is that after I've deployed those resources, I need to be able to achieve my financial objectives. So basically, that is what it is up for. So that is financial management. Now, we said this word, we mentioned the financial objective of the entity. Now, you see, when it comes to the financial management concept, the underpinning concept of an entity's objective, the main reason why an entity is existing is that, anyway, let me even ask you, why do you think entity exists? What comes into your mind? What do you think is the sole objective of an entity? The underlying principle or assumption of an entity. Why do you think they exist? Yes, anyone? Yes,
To make profits.
to make profit. All right. Yes, any other person? So, like she's saying that an entity exists to make profit. Now, let me show you the lens she used to say, make that statement. The lens she used to make that statement is the company. So, and you must understand that when we talk about an entity, this is how an entity is constructed. We have shareholders. And we know shareholders are what? Owners of an entity. They are also called the principals. Now, these shareholders are the people who use their resources to establish an entity, and the entity is run by the board of directors. We call them the people who have control, and they are also the agents. Now, when I ask the question, what is the underlying assumption, underlying reason for an entity's existence? She said profit. The profit she mentioned is because she was looking at these people, because the board of directors of an entity are always talking about profit. That is that. That is that. But for financial management, what we are saying is that, yes, profit is an objective of an entity, the existence of an entity, but it is not the number one objective. It is not the underlying factor of financial management. And that thing in itself is a question, an examinable question. It has happened before. Now, because these people are the ones who use their money to form the company, they cannot have like a direct profit. The definition or the technical term for them in terms of their profit is called their wealth maximization. Wealth maximization. So here, what you see is that for the shareholder, what they are interested in is that they are interested in their wealth maximization. So you see in here that wealth maximization is their focus. Maximization is their focus. They want to increase their shareholders' wealth. That is what they are looking out for. They are not looking out for what the directors are looking out for. For them, what they are looking out for is simply to increase their wealth. So each and every time, what they want to see is that their wealth is increasing. Today they had 2, tomorrow they are going into 5, like 10, like that. They are increasing in their wealth. So the underlying assumption of this topic or this syllabus or this subject is that the purpose is for shareholder wealth maximization. Of course, if you don't make profit, how can you have shareholder wealth maximization? So the examiner can give you an argumentative question for you to discuss. Should we look at profit or we should look at shareholder wealth maximization? Now, later on, I will explain to you why we should focus on shareholder wealth maximization and not profit. Even though without profit, there will be no shareholder wealth maximization. I will explain to you. Because later on, I will tell you that profit is not a real figure. People can manipulate profit. So if you use profit, people can just be manipulating the things. But the real worth of the entity determines whether the entity is doing well or not. Yeah. Therefore, if we say that the underlying assumption for financial management is shareholder wealth maximization, then what is shareholder wealth maximization? The shareholder wealth maximization simply means that the investment returns of the shareholder is increasing, and that is measured by two main ways. The shareholder wealth maximization is measured using two main key pointers. How do you know the shareholder will increase his wealth? The shareholder will increase his wealth, number one, through the fact that he is collecting dividends. Dividend. So every shareholder takes dividend. So the fact that he is getting dividend will tell you that his wealth is increasing. He is getting returns. So dividend is his return on the money that he invested in. Another way you can know that the shareholder is increasing in his wealth is also the fact that the share price of that shareholder will increase. The share price of that shareholder will increase. So we are talking about increase in share price. In share price. So these are the two main ways a shareholder wealth can be maximized. Now, what is dividend? We know that dividend is simply the money that the return they get out of their investment. Then what is share price? Share price is increase in share price is the fact that, let's say I did an investment by buying a share. I bought the share at 2 Ghana cedis. Now, at this point, as we are standing, the share price is, let's say, 5 Ghana cedis, which tells me that I have increased my wealth by 3 Ghana cedis. This is the concept clearly understood. It's a very important concept because everything in financial management is based on this. If you miss this underlying assumption, everything will go haywire. So you need to understand that the purpose, the financial objective of an entity, number one, is not really about profit. It's about the shareholder wealth maximization. So the focus is not the board of directors. The focus is the person who used his money to establish the business. So some people say that if we don't have profit, then how can we increase the shareholder wealth maximization? Because dividend is paid out of profit. Now, the question, the other side of the argument is that, okay, you are talking about profit, but how did you even start thinking about profit? Is it not somebody that uses money to establish the business for you to even start thinking about profit? So it means that if the person doesn't establish the business for you to become a board of director to run it, you can't even be talking about profit. So that is why the focus of financial management is on shareholder wealth maximization rather than the profit. Please, I hope that part is understood now. Why we focus on shareholder wealth maximization and not profit. Is that understood now? Do you get the concept now?
Yes, sir.
Yeah. So when it comes to the fact that you have to make an argument to support that thing, then it means that you have to go this tangent. All right. As we continue, we said that there must be increase in share price so that we can know that the shareholder wealth can be maximized. And again, we also explained that dividends is another thing. Now, what we are going to see in here is that how does the shareholder have an increase in share price? We all know that if the company keeps making profit, all right, definitely, automatically, it will feed into its value. And so therefore, the earnings of the company will increase, then the earnings per share too will increase. So that is how that one runs. But in a practical sense, anytime you see that somebody has won a major contract, an entity has won a major contract, there will definitely be a share price increase. And later on, we will learn something called efficient market hypothesis, information system, how prices go up and down in the market. Yes, immediately somebody hears that the person has, an entity has won a contract, it will push their prices to go up immediately. Take your life, for example. The day you get an employment contract letter, that day your price will go up. Yeah. And everybody around you will start saying that this guy has money. But it's just a contract you just won. They've already calculated your life for you that you'll be getting salary. And so your value will go up. That's how it is. And so therefore, if a company also wins a contract, the same thing that happens. Again, if they do a takeover bid, they win a takeover bid. So if an entity buys another entity, we will be seeing what we call an increase in share price. Again, there is something called share buyback. And share buyback is just a technical concept. So if you have done FR before, you learn something called earnings per share, which is profit after tax over the ordinary shares. Now, if you buy back some of your shares from the public, the entity buys the shares. It doesn't give it to anybody. The entity buys the shares, and the entity will put the shares into something, a place we call treasury shares. That shares is for the entities, not for anyone. So what has happened is that they bought part of the ordinary share. So you see, the ordinary share will reduce. So assuming your profit was 10 and your ordinary shares before was 5, you realize that your answer is 2. The share price is 2. Now, when they reduce by buying some of the shares, your 10 is still there. But what you realize is that, let's say they bought 3, you'll be left with 2. So automatically that will increase this one to 5. That is what we call share buyback. When they buy back some of the shares, it actually reduces the shares and also increases their price. So that is that. And so we also say that if the company keeps on making profit, automatically their value will go up. All right. So that is that. And let me even say that sometimes if they get a potent CEO, everybody knows that he's coming to do things well and the profitability will go up. Or the announcement of an attractive strategy. Anytime you hear that there is an announcement of a good strategy, your value will go up. This is what the politicians have been using, that they do a manifesto to announce a lucrative strategy and you vote for them. That is what happens. In a business sense, it's happening the same way. If a pharmaceutical company says that they've discovered a new product that can cure malaria in a day, their value will increase. So that is how it works. And these are insider information that it is illegal for people to get, but people still get them. All right. So basically that is that. So that is financial management for you. This is the nature and the sole purpose of financial management. So this part can form a question for you to answer. Now that we know this, the next thing we are going to look at is the functions or responsibility of a finance manager or finance management. Functions or the responsibility of financial management or a finance manager. There are 7 functions he performs. 3 of them are very crucial. One is investment decisions, and that is where we will be looking at investment appraisals, investment decisions. 2, we will be looking at financing decisions. And like I said, don't study this thing just for finance management. It is useful for your strategic case study. Number 3 is dividend decisions. He has to make those decisions. Then number 4, we will be talking about financial planning and control. Financial planning and control. 5, we'll be talking about risk management. And that is the treasury management thing I spoke about. That one too is a key topic for 15 marks. Then 6, we will be talking about communicating policies to stakeholders. Communicating policies to stakeholders. And that is where we will be talking about sustainability. Sustainability is very key, and it has become the backdrop of the new syllabus. Then the last thing that we will be talking about is efficient and effective use of resources. And these will be the 7 functions. The efficient and effective use of resources. All right. So these are the functions of finance manager. So if you say you are a finance manager in an entity, these are what you'll be doing. So these are your 7 major roles. If you go for an interview, they ask you, what do you think you foresee yourself doing here as a finance manager? These are the things you bring about. Now, what is investment decision? Of course, investment is investment. What we are talking about here is that every entity seeks to achieve the shareholder wealth maximization by identifying investment avenues so that they can invest in. All right. So that is basically what it is. You want to find out where you want to put money. And so when you find out where you want to put the money, then you put the money in there. Everybody must make an investment. So you find out where you have to put your money, then you put your money in there. So in investment decisions, there are some processes that you go through. Number 1 is that as it is, you will need to kind of spot some investment that you want to undertake. So you have what we call project identification. You need to identify an investment or investment identification. You need to identify it. All right. When you identify it, then the next thing is for you to go through that investment and evaluate them. You have so many investment opportunities. Which one is the best? So your next thing to do is project evaluation. Evaluate them. And that is what we will be learning later as investment appraiser. So we will be appraising them. All right. We will use the methods to appraise them. When we appraise them, we will select. So you do project selection. You select it. Then you implement it. You implement the project. All right. You implement project. So project implementation. Then the last one will be project monitoring. And that is something that is at the heart of financial management. When you are doing investments, you don't just do it like the way the government has been doing. They just do. We don't see any monitoring. We don't see any evaluation. We don't see anything. So you hear the auditor's report always bashing up things. So that is that. You have to identify a project, evaluate the project, select the best, implement it, and monitor the progress of the investment. So that is the first function. It's a function of the finance manager. That is what you are brought in to do. So me, I don't like to be called a finance manager because I don't do these things. I call myself an accountant. If you are in the finance department as a team lead, you're a team lead. Because if you say you are the finance manager, how many investment opportunities have you brought about? Yeah, you need to fish out. Your company may be selling corn, but you sit down and say, oh, let's buy some 5 Uber cars and give to some people to drive. I mean, you are thinking of means you can get money. That's the role of a finance manager. Then, of course, since you spotted that, oh, I have seen this investment. Where do we get the money to start the investment? So we will be talking about financing decisions. All right. We will be looking at that extensively, very, very extensively. And that is the part that is that business finance. All right. In some cases, even the investment, there is an argument of let's start afresh. Let's save money and start a new business, or a business already exists. Let's just go and buy it. So we'll be learning that doing the business from the scratch, from your own savings, and start to build it. Let's say I want to go into an investment of constructing or building a school. Should I get a land, build the buildings, and start advertising for people to come in? Or I should just go to somewhere, Tema International School, where I live, then you just buy the school. Then it means you have a school. So we have the organic one, organic, which means that you are the one going to start, or you are going to acquire. So we have pros and cons of that one. Sometimes when you acquire somebody's business, there are some bad liabilities there you may not know that when you buy, immediately you buy, you inherit it. Yeah, it happens like that. But then the one that you are saying you are saving money to construct your own business, by the time you finish saving the money, inflation has cut you. You have to continue saving. It's like when I wanted to save money to buy a car, I saved money. First time, 42,000 Ghana cedis. I said, I'm going to buy a car. I went there, they said the price has increased. 60,000. When I save up to 60,000, I go again, they say it's 80,000. So it means that the way the thing is going, I need to go and borrow money and buy it at once. That is how the trajectory is. So it's either you do it organically, starting from scratch, or you acquire. Now, this is what people are battling with in strategic case study, because it's a strategy. It's either you acquire somebody or you do from scratch. You weigh the pros and cons for that, then you know what to do. Now, when it comes to the financing decision, we are going to learn about the sources of finance. Where can we get the money? Sources. All right. Are we going long-term loans? Are we going short-term? Are we going to the bank? Are we using our retained earnings? So we will be learning that. All right. But to every source of finance, there is a cost. There is a cost. There's a cost and there is a risk. There's a cost and there is a risk. Yeah, that is it. If you go and borrow money from the bank, you pay interest. That's your cost. If you use your own money to do it, there's opportunity cost. You could have used the money to buy another thing, but you use it to do this one. So we will be learning that. But these are the summary or the explanations you can give for financing decisions. Then we come to dividend decisions. Now, when it comes to dividend decisions, there are two theories that regulate dividend decisions. We have, number one, the dividend irrelevant theory. Dividend irrelevant theory. Then we have the bird in hand theory. The bird in hand theory. Now, this one was developed by M&M, Modigliani and Miller. Those people are very interesting people. They are very interesting people who even develop things for us in what do we call it? Capital structure, when it comes to capital structure decision making. Now, what are they saying? You see, dividend is something that increases a shareholder wealth. We have learned that. We know that. It increases shareholder wealth. But these people are saying that there is no need for you to pay dividend, because dividend is not the only means by which shareholder wealth can be maximized. What is the other means shareholder wealth can be maximized? We just discussed that. What is the other means shareholder wealth can be maximized? Yes, Kevin. Come again. Increment in share price. Yeah. So we all know that share price can also bring about shareholder wealth maximization. So what they are saying is that so if you get profit, why should you use some of the profit to pay dividend when you can use the entire profit you had to do another investment? And we've also learned that share prices increases the more you do profitable investment. So they are saying that don't pay the dividend, just use the money to invest in a more profitable investment. And as you are doing a more profitable investment, automatically the shareholder wealth will increase without you paying the dividend. Are you getting their concept? Does it make sense to you? Yeah, it makes sense. So if we do a positive NPV project, then the company will be earning more. And the more you earn, we say profit after tax over ordinary shares. The more profit after tax is going up, you will be increasing in your share price, your share dividend. So why should you reduce some of the money to pay dividend so that the money that you can use to do investment is now in a short amount? So don't pay the dividend. That is what they are trying to say. Just don't pay the dividend. Just use the money to do profitable investment. But there is another batch, the Luther people. They are saying that, Oga, what are you talking about as investment? Bird in hand. When the bird is in your hands, you are more secured than when the bird is in another hands. It can fly away. So you give me the money, pay me my dividend. If there is any other profitable investment, I myself, I will go and do it. Are you getting that those people's position too? So they said that future is uncertain. So give me the money today. I will decide myself what to use, how to operate my own, regulate my own future movement. All right. So we have the dividend irrelevant theory that says that dividend is irrelevant so far as you can use the money to invest in a more positive NPV project to increase the shareholder wealth. Then we have the bird in hand theory that says that future is uncertain. Give me the money now. When the money is in my hands, I can now find for myself another investment to invest the money. So that is the two issues around it. So are we going to pay dividend or we are not going to pay dividend? Will depend on this theory. So that is the part of the dividend decision. Then we have financial planning and control. Here, the whole thing is that you should plan your finances well. Because, and that is where we will be talking about working capital. It's part of working capital. Working capital. You see, the issue is that sometimes you can have some people who don't plan well. They don't plan their things well. Now, me, I've worked in an entity, a Ghanaian entity, whereby we have so much profit, but we didn't have money to pay salary. So you see, cash flow is different from profit. Profit is an accounting issue, but cash flow is reality. Now, what happened in there is that you see that the entity is getting more profit, but all their monies are tied in receivables. They sold on credit. So far as the receivables have been paid, they don't have cash. So it means herein you need to plan your cash flow. So financial planning is planning your financial resources so that at any point in time, there is cash flow. So that is it. That is how it works. So don't let the money be with other people. At any point in time, there is cash flow. You need to control your cash. So that is part of the controlling. So do a strategic planning, control your cash. There's something called, and that thing I just mentioned is called strategic fund management. Strategic fund management, making sure that at every point in time, there is cash flow in your entity so that when emergency comes, you can use those monies to deal with them. All right. So that is that part. Then we will talk about risk management. Of course, we were looking at treasury. And here, the main focus is about FX, foreign exchange or foreign exchange rate. If you are a Ghanaian, this is a place of interest. The way the interest rate, the exchange rate keeps going down, up, and up. Not only that, you should also be concerned with interest rates. Interest rates. All right. So that is that. Be concerned with interest rates. All right. So that is also very, very important. Okay. I have a message from one of you. Let me check. That is better, right? All right. Okay. So that's fine. Now, then the sixth thing will be about communicating to policies to stakeholders. And here it has become a major issue. That is the reason why they change your syllabus. Sustainability. In Ghana, everything these days is about sustainability. One president said that he hasn't seen a pregnant woman that talks about sustainability. They want to give birth. They don't want to sustain the pregnancy. So Africa is already pregnant. What is sustainability? Give us the money, we will do proper things. Sustainability is a secondary effect. Yeah, one African president said that, and it's very interesting. Very, very interesting. Now, we are talking about communicating policies to stakeholders. You see, an organization have majorly 3 groups of stakeholders. We have the internal stakeholders. So when you are talking about sustainability, you need to look at them in perspective. Your employees, your management. What are you doing to sustain them? That is one part. Then we have the external people. The external stakeholders. Who do you think are the external stakeholders of an entity? Any idea? Because when you talk about the external holders of an entity, the external, our focus is on the government. Key one, the government who takes taxes. We are also looking at the regulators. The regulators. We are looking at the community. So sustainability is very important. We are also looking at the pressure groups. The pressure groups. These are the external. But when you talk about some people like the customers, the shareholders, the suppliers, the banks, the competitors, we don't call them externals. We call them the connected stakeholders. So please be very careful not to confuse the connected stakeholders with the external, because here we are looking at the shareholders. They are connected to the entity. These people are far from the entity a little. We are talking about the customers, talking about the suppliers. We are talking about the banks, finance providers. So let me generalize them and call them the finance providers. And your own competitors. So these are the connected people. All right. They are connected to your entities. All right. Then the last aspect of this function is efficient and effective use of resources. When we say somebody is efficient, so here our focus is on the 3 E's, and the fact that you have done public sector makes this one easy. When we say the 3 E's, we are talking about economy, right? So the right statement you can make for this is efficient and effective use of economic resources, so that you can remember all the 3. All right, so that is that. So economy, efficiency, and effectiveness. I think by now everybody knows how to explain these 2. So can you help me? What is economy? Yes. When we say economy or economic, economy, not the economy as in the state, in finance management. Economy, what does it mean? Yes, anyone? You did it in public sector, right?
Yes, sir.
Yeah. What is the idea it communicates?
So getting resources at least prices without compromising quality.
Exactly. Getting it at minimal prices without compromising on, I like that part, without compromising on quality. All right, that is that. Then efficiency is about the ratio of output to input. So that quality resource you had at a very small price, which is going to be your input, you should be able to produce more output out of it. So achieving a higher level of output with a little input that you have. So you see, this one is quantitative. Quantitative. Then effectiveness is about achieving your target. All right. So it's about target achievement. So it's more of qualitative. All right. So that is the kind of thing that you see there. All right. So these are the functions of finance manager. Now, the examiner normally says explain 3 functions. Now, let me do this. When it comes to this main 3, there is also an argument. I remember when I was writing advanced financial management, that was my question. Discuss the interplay between these three major decisions. These are the three major decisions, bear in mind, major decisions. So if you forget any of these decisions, it's not these three. Now they say that which one should come first? Is it investment decision? Is it financing decision? Or is it a dividend decisions? Which one should come first? Yes, and let's discuss in a few minutes. Which one do you think should come first and why? Why? Yes, anyone should just let us know what he or she thinks. Yes, anyone, please, let's be fast. Yes, class, anyone, please. Or you want me to mention names? Yes, Amma, which one do you think should come first? Investment decisions, financing, and which one do you think should come first?
Yeah. I think the financing decision should come first.
Why?
That's because you source for the funds first. You decide the funds that you want, the source of finance first, before you look at the investment decision, the projects you want to invest the money into.
I like that. That's fine. So she goes for financing first, because if you don't have the money, how can you start the investment? Yes, who else? Yes, anyone having a different opinion? But somebody too can say that, let me see the investment, see the viability of the investment before I go and look for the finance. That is another perspective. Then another perspective will say that, the person who is going to give you the finance will be thinking about how much he will get, the returns he will get. So the dividend decision is the first thing he's looking at before he can give you the finance for you to go and do the investment. Another person will also say that, okay, you found the investment, you determine the source of the finance, and you are telling the person that since you are the one giving me the finance, I will also be paying you dividend of a so amount. So you see, it's not by force that one should be the first. It depends on how you explain them. All right. So there is no straight answer to that. All right. So that is that. So you can explain it in the diverse ways you feel best. All right. So that is that. That is that. All right. So now, what I'm going to do now is to pause here and bring out the past questions for us to answer from this side. All right. You answer from this side and we will move on very shortly. So let's look at some of the past questions. So let's deal with some of the past questions, as you can see. So this one is talking about, is seeking you to explain the concept of value for money, the 3 E's. All right. So that is that. Now, the second part of the question says, compare and construct value for money, which is this 3E, and corporate wealth or corporate value maximization. You remember we spoke about wealth maximization. So as you can see, later on, you realize that the value for money concept is more of a public sector purpose, suited purpose, or more of a non-profit making organization suited purpose. Then the corporate value maximization is about the fact that you want to increase the wealth of the shareholder. You see, the economy efficiency and the effectiveness, as it is seen in the public sector, it's not about profitability. No, it's not about that. And the outlook, the stakeholder is the individuals in the state, not the the person kind of doing the business, investing money and all that, the shareholder kind of. In the public sector, the shareholders are the individuals in the state. So that is the comparison and the contrasting things that you can do over there. But before I move on to anything, I just want to ask you a question. When we say the concept is saying shareholder wealth maximization, is there a difference? What is the difference between shareholder wealth maximization? I.e., the word that I'm focusing on is this word, the word maximization. Maximization versus satisfaction, shareholder satisfaction. What is the difference between maximization and satisfaction? You see, the difference is that when we say somebody is satisfied, he is full. You get the food and we ask you, are you satisfied? It means you are full, you are okay. But maximization, you are never okay. When you get to a point, you want more. You want more. You want more. You are always maximizing. So the focus is not shareholder satisfaction. It is about shareholder wealth maximization. You want more all the time. Is that okay? All right. So take note of that. And there are past questions again that ask you, we will come to this, and that is the next thing we will be talking about, the financial objectives and the non-financial objectives. That's the next thing we'll be talking about. So you should be able to deal with it. All right. That is that. Then you see, explain why shareholder maximization of share price is the preferred financial objective to maximization of its sales. We've done that, right? Profit versus maximization. Explain why. 6 marks. So everything we are doing, just be mindful of it. Those are your exam questions. They are your exam questions. So just be mindful of that. They keep repeating it. And when we look at the objectives, you realize that, okay, the objectives, we are come to that. Of course, we've already done the objective for a non-profit making organization, which is the value for money, the 3 E's. So you explain the 3 E's, you are done. All right. So these are the things. So explain appropriate measure of each financial, economy, efficiency, and effectiveness. So how do you measure it? We spoke about the fact of economy, getting the thing at a cheaper price without compromising on quality. And we spoke about efficiency. All right. Then we will be looking at how you measure those things a little. All right. So that is that. All right. You see, it was a municipal assembly, a public sector. So we will look at that. All right. So, but just to show you that the things we are doing are your exam questions. The explanation I'm giving you, they are your exam questions. So don't make it an abstract. All right. Don't make it an abstract thing. They are your exam questions. All right. So now let's move on to another thing. Now, we are going to look at the financial objectives and the non-financial objectives of business. So we'll be looking at the private sector. We'll be looking at the public sector. So the second phase of what we are going to do is the financial objectives and the other objective of an entity. All right. So that kind of is a part 2 of this same introduction to financial management.